Let me tell you something uncomfortable.
The biggest threat to your money isn't a recession.
It isn't a market crash. It isn't some villain on Wall Street plotting against the little guy. The biggest threat to your money is the person staring back at you in the mirror. Because the truth is, the market doesn't destroy most investors. They quietly destroy themselves, one well-intentioned mistake at a time. So today, I want to walk you through 12 of those mistakes, the ones that silently drain fortunes, and I want to show you the cold math behind each one. Stick around, because the last few are the ones almost nobody sees coming. Let's start with the first one, trying to time the market. Here's the thing people misunderstand. The market does not grow in a smooth, predictable line. The vast majority of its growth happens on a tiny handful of explosive days, and those days don't send you a calendar invite. Look at the math. If you invest $10,000 and just leave it alone for 20 years, it grows to roughly $65,000. But if you miss just the 10 best days out of those entire 2 decades, your return drops to about $29,000. Think about that. 10 days out of roughly 5,000 trading days, and your wealth gets cut nearly in half. And here's the part that traps people. 7 of those 10 best days historically happened within 2 weeks of the 10 worst days. So the investor who panics during a crash and sells to wait for things to calm down almost mathematically guarantees they will miss the rebound, and they end up buying back in at higher prices. You don't time the market, you spend time in the market. The second mistake is paying high fees. I want you to picture a silent roommate. He pays no rent. He does no chores, he just lives in your house, and decades later he walks away with half of everything you built. That roommate is the management fee. Here's the math that should make you angry. Invest $100,000 for 30 years at a 7% annual return with 0 fees, and you finish with about $760,000. Now add a 1% fee, and you drop to $570,000. Add a 2% fee, and you fall all the way to $430,000. That 2% quietly ate $330,000, which is 43% of your total potential wealth. Stretch it over 40 years, and the fee takes more than half of everything you made. This is exactly why plain, unmanaged S&P 500 index funds reliably beat elite, hand-picked hedge funds over the long run. The fees create so much drag that the professionals simply can't keep up. The third mistake is letting fear and greed run the show. We call it overtrading. The data here is brutal. In certain periods, the market returned around 17.9% a year, while the most active traders earned only about 11.4%. They worked harder, watched the screen more, and earned less. Overtrading hurts you in 3 compounding ways at once. First, it racks up trading costs. Second, it lowers your mathematical odds of being right, because now you have to guess correctly over and over again. And third, every time you take a short-term profit, you trigger a tax bill, draining money that could have stayed invested and kept compounding. Activity feels productive. In investing, activity is usually just expensive. The investor who checks the screen 20 times a day isn't more informed, they're just more anxious, and the market quietly charges them for that anxiety. Now let's jump ahead to the 5th mistake, investing in things you don't understand. Liking a product is not the same as understanding a business. You can love a coffee brand and have absolutely no idea about its profit margins, its debt load, or its competitive weaknesses. The legendary investors talk about a circle of competence, which simply means knowing exactly where the edge of your knowledge ends. The danger comes when you step outside that circle, into hyped sectors like complex biotech, AI, or crypto, just because the price is climbing and you're scared of missing out. But a rising price is not knowledge. A rising price is bait. And when the hype cools, the people who never understood what they owned are the first to panic and sell at the very bottom. You can't hold an asset through fear if you never understood why you bought it in the first place. Conviction comes from knowledge, not from a green chart. The sixth mistake is anchoring on the price you paid. Picture buying a stock at $50. It falls to $30. Suddenly, that number, 50, becomes emotionally sacred to you. So you buy more at 30 because it feels like a bargain. It drops to 20 and you buy even more. This is called averaging down, and it's often just catching a falling knife. Here's the trap. Cheaper than yesterday is not the same as cheap. A stock can fall 90% and still be wildly overpriced if the underlying business is rotting. Shoveling more money in just because it dropped is treating a dying company like it's on sale. There's only one rational question to ask. Knowing what I know right now, would I buy this asset today? If the answer is no, then holding it is just pride. Stop digging the hole. The seventh mistake is following the crowd.
There's a beautiful analogy for this. Investing in a giant bubble is like Cinderella at the ball.
Everyone knows the magic ends at midnight. Everyone knows the speculative junk they're holding turns back into pumpkins. But everyone is getting rich so fast that they quietly promise themselves they'll sell and slip out at 1 minute to midnight. The problem? In the stock market, the clocks have no hands. The crowd gives you incredible emotional comfort, but the crowd is not a fact checker. A group chat full of confident strangers can pull you into a terrible position through sheer volume and conviction, and not one of them will tap you on the shoulder to tell you the top is in. The eighth mistake is using leverage, which just means borrowing money to invest. Leverage is a magnifying glass. It takes small gains and makes them huge. But it does the exact same thing to your losses. If you control $25 for every $1 of real cash, then a mere 4% drop in the market wipes out 100% of your actual money. And here's what really kills people. A normal 25% market drop is completely harmless to a patient investor who can just wait for the recovery. But if you borrowed money, that same drop triggers a margin call. The broker demands their money back immediately, forcing you to sell at the absolute bottom. Leverage saws off the floor of your portfolio. It strips away your single greatest advantage, which is the ability to wait. The ninth mistake is confusing price with value, and these are two completely different things. Price is just a flickering number on a screen, set by the daily mood, the panic, and the greed of millions of strangers. Value is the actual worth of a business, based on the cold, hard cash it can generate over its lifetime. Think of it like buying 10% of your local laundromat. You wouldn't care what the price of that laundromat did on a random Tuesday afternoon. You'd only care about how much cash those machines bring in. Stocks deserve the exact same treatment as slices of real businesses. When you actually know what a business is worth, a 30% drop in price isn't terrifying. It's a discount. Speculators buy hoping the price climbs for the next buyer. Real investors buy because the cash flow makes it worth it. The 10th mistake might be the most expensive of them all: selling your winners too early and underestimating time. People love to lock in a profit, but selling a magnificent compounding asset early is like amputating your own future. Here's why. Compound growth is not a straight diagonal line. It's a flat curve that does almost nothing for years and then suddenly goes vertical. Take $10,000 at 10% for 30 years and it becomes $174,000. But leave it just 10 more years for 40 years total and it explodes to $452,000. Over 60% of your final wealth gets created in that final decade. So if you get bored and sell at year 15 because the gains look slow, you are walking out of the theater right before the movie gets good. Those boring, flat years are exactly when you're buying the cheap shares that do the heaviest lifting decades later. The 11th mistake is getting diversification wrong. And you can actually get it wrong in both directions. It all depends on who you are. If you are a true expert who deeply analyzes businesses, then spreading your money across 50 mediocre companies just to feel safe only waters down your best ideas. But for the average person, the opposite is true. If you can't confidently defend the balance sheet and the competitive moat of every single stock you own, then betting on individual stocks is just dangerous ego. For most of us, embracing maximum diversification by pouring money into one single, low-cost S&P 500 index fund is the ultimate act of financial freedom and safety. And that brings us to the 12th mistake, hiding in cash and ignoring inflation. After watching a few crashes, a lot of people decide that keeping their life savings in cash is the safe, responsible thing to do. But here's the brutal truth. Cash is the only asset mathematically guaranteed to lose value. Inflation is a quiet tax that never shows up on a single bank statement. At a normal 3% inflation rate, a dollar loses almost half its purchasing power over 20 years. Your safe $100,000 in cash will still read $100,000 on the screen decades later, but it will only buy what $55,000 buys today. It doesn't crash, it just slowly bleeds out. Now, this doesn't mean cash is evil. Short-term money, your emergency fund for a broken car or a lost job, absolutely belongs in stable cash. But long-term wealth, money you won't touch for 10, 20, or 30 years, has to be invested in productive assets like stocks and real estate just to outrun inflation. So there they are, 12 mistakes. And notice the pattern. Almost none of them are about being smart enough. They're about being patient enough, humble enough, and disciplined enough to get out of your own way. You don't have to predict the future. You don't have to pick the perfect stock. You just have to avoid these silent, self-inflicted wounds and let time do the heavy lifting. Master your own behavior, and the math starts working for you instead of against you. If this helped you see your own money a little more clearly, do me a favor and hit that subscribe button so you don't miss what's coming next. Give this video a like so it reaches more people who need to hear it. And tell me in the comments, which of these 12 mistakes have you made yourself? I read every single one. Thanks for watching, and I'll see you in the next one.